Okay. Cool. Thanks everybody for joining. Looks like we have a pretty big crowd. I could be a little hoarse because I just went through another 2 hours before this in Chinese. If you want to hear me give it again in Chinese, I can stay and give another session on Chinese. But it was good practice. I was starting to forget some of the terms. So thank you guys for coming. So this is a meetup that I usually hold every month or so, and we talk about many different stuff. So we talk anywhere from lending. We talk about how to acquire properties, how to run them. What kind of surprises that we end up getting. But I usually have to talk a lot. So what I started cheating is I started inviting special guests that fly in from Dallas. Okay, so I would get some of the national commercial brokers, some lenders, property management people to come here and speak so that I don't have to. Okay, and they know way more than I do. I'm Tony, by the way. And then today I found a new way to cheat is, I actually, I love doing multifamily. I love doing commercial assets, right? But there were people that really helped me out when I got started. Okay, I had a lot of great mentors that, I could always bounce ideas off of, and they taught me a lot of things that you can't learn from mentorship groups or something. Okay, so to give back, I also started offloading some of my knowledge to the poor sobs here. So today's session is special, okay, because the new squad, as I call them, are going to also present a lot of this. Okay, so I really encourage, I really wish that I was 20 years younger and know what they know now. I think it's so great that there's so many people learning. Okay. So without further ado, I'm going to go ahead and get started, but I'll quickly turn over the floor. So quick disclaimer, okay? So this meetup is really for educational and entertainment purpose only. So we're not brokers, we're not agents, not attorneys, no legal advice, don't sue us, okay? We're not selling anything in this meetup. It's really for education, but I believe that once everybody get very well educated, well versed on what to look for in a lot of these deals, you guys will be able to make your own decisions on what are good deals, what are some good metrics to pick out. Okay. So, so today's meetup is all about the Linfinity squad. Okay, this is Linfinity Campus is this course for free that I'm teaching to some of the people. So the first victims are, Ian, Patrick, Stella, Jamie, Derek, Tracy, Hu, and Samson. Okay, so a lot of them are actually not here because they're either in Mexico enjoying a vacation, or they have like a concert to go to tonight or something like that. But yeah, feel free to grab more chairs, and there's actually some more spots over here too. So if you have any questions, as they come on, see them, target them, okay? And feel free to ask them questions, okay? Because I think it's a great learning experience for them too, okay? But I'll always be around to answer any questions. Okay. So the agenda for today, first, we're going to quickly go over the team introduction. I'm going to talk, we're going to talk about the current market conditions, okay? We all know it's a big inflationary environment, but how can we take advantage of it, right? There's things that we can't change. We can't change the inflation. We can't really change what the Fed is doing to tamp down the inflation. So how do we make money from it, right? You should be able to make money whether it's a down market or up market, okay? And then we'll talk about a little bit about, give an intro to multifamily. And then we'll talk about like syndications, right? A lot of people don't know what a syndication is. Let's do a quick overview of that. Okay. So a little bit about us, so we have, so our company is called Link Multifamily. It is with my partner, Jack. Jack Wayne, okay, and me, Tony. Okay, so but who are we? We are really a group of out-of-state investors. Okay, so even though we all pretty much live in California, we do have many people around the US as well, but we live in California, but we don't invest in California. Okay, it's anti-landlord. It is not. It is too friendly to tenants, and it's hard to cash flow here. Okay, so we tend to look outside of California for assets that we can invest in. Okay, so far on the active GP side, we have acquired about 750 multifamily units, pretty much all in Texas. That's where our current expertise is. So about $86 million worth of assets. So we raised about $15 million in funding with about 100 active investors right now. But our total club size is much bigger than that. I think we're over 1,200. That's what you see on Meetup. We have a separate Asian list, so we have the nice thing about having a large group is we're able to buy larger and higher quality, institutional quality assets, right? So, the more people we have, literally the better and bigger assets that we can buy, okay? So apartments really come in a few flavors and, few vintages, as we call them. So Class A is really your Santana Row. It is your Mission Bay, the brand new builds. Okay, so usually built after the year 2000s, really nice amenities, granite, stainless steel stuff, okay? And they trade for, in Dallas, they pretty much trade for something, of 4 cap, okay, and $2,000 in rent, okay? So for those people that are not familiar with cap rate is basically your business income divided by the price that you have bought it for, okay? So it's a measure of how much are you paying for a certain amount of business income. So the lower the cap rate, that means you're paying more money for less income. And then the higher cap rate means you're paying less for more income, right? So in places like San Francisco, you're gonna see like really low cap rate, like 3%, okay? In places in the middle of nowhere, you'll probably see really good cap rate, like 12%. But that's also because the risk of failure is much higher over there. Whereas the risk of failure in San Francisco, where there's a lot of tech people who can afford these things, is much better, right? So your return is a little bit lower when the risk is lower, okay? So, so for every dollar, you get, you get valuation. So 1 divided by 4% is a 25x multiplier, okay? So if a property makes $1 million in net income, okay, this property at 4 cap is a 25x multiplier. So $1 million in a 25x environment means this property is worth $25 million. Okay. Now, our whole goal is to buy a property that still has some upside to it. Okay, either because they weren't managing it very well, or because they haven't raised rent yet, or they haven't improved the property. So if they were under managing it, let's say they were only making $800,000 in income, okay? Let's say it's a 5 cap, right? So $800,000 in a 5 cap is a 20x multiplier, right? So $800,000 times 20, that means this property is worth 16 million. We would buy it for 16. We would take it over, improve operation, renovate the interior, and let's say now we can make $1.2 million in income. Well, now this apartment is now worth 24 million. Okay, so it literally, just by improving and making your income better, you increase value from 16 million to 24 million without having to gamble that the market is going to go up in the future. Okay, we don't gamble with whether the market goes up and down. We don't make money from that. We make money from forced appreciation that is within our control. Okay, any questions about that? So Class A, Class B, Class C, we like to invest in Class B, what we call workforce housing, okay? The reason is in a recession, So usually the type of stuff I invest in is I wanted to still do well even in a downturn, in a recession, because I want to preserve my capital. Okay, so in a recession, Class A people don't want to pay the high rent, so Class A people move down to Class B. Class B people move down to Class C. Class C people don't move down any further because that's Oakland, that's gangland. Okay, they will do whatever it takes to stay in Class B and Class C. You know, maybe getting roommates, maybe moving in with their parents. Okay, you know, they'll do whatever to stay in these two classes. Okay, but in a downturn, these classes are full. They're always full. Well, Class A, as you guys saw during the COVID downturn, they have to offer like $1,000 discount and even like 2 months of free rent, right? In order to attract people, right? That's the first thing to get damaged, to be impacted. Okay. So here's our current portfolio. We own 4 Class B and 2 Class B and 2 Class C properties. Okay. So the first one, Running Brook, we bought it for 20 million. It's probably worth like 38 right now. Okay. Encore, same thing, 23 million. This one actually is total cash cow. We like to buy near airport and major logistics centers. So all of these are right around the Dallas-Fort Worth airport. Okay. The third one, Arbor Terrace, we bought that 3 years ago. We actually already sold it. Okay, so our original projection was around 13% return a year. Turns out we actually made 145% return in 3 years. So about 45% return a year or so. Okay, so that's not normal. It's not indicative of future performances, but basically, you know, our goal is to double the money, double the investors' money. It could take longer, okay? Because if we go through a prolonged recession, it could take more, 2 years more to double people's money, or it could end up only taking 3 years, like in this case, right? So our crystal ball has been kind of broken lately. We can only see about half a year to a year down the road. So yeah, but as long as you have a good business plan on how you can execute for the long term, you guys, we can do pretty well. Okay, as long as we have a conservative assumptions and conservative underwriting, which is totally key. Okay, and most recently we bought Vanderbilt, which is 152 units, 24 million. The raise on that one was about 9 million. Okay, and thanks to the size of our club, we raised that 9 million in less than a week. So yeah. So right now, that most recent property is also doing really well. We exceeded our pro forma rent, our year 3 pro forma rent. We already exceeded that within like less than 6 months. Okay, so rents are still really going up in, if you're picking the correct markets. Okay. So a little bit about me. I'm a total techie. My background is in software engineering, and I've been working in Silicon Valley for over 20 years. I really enjoy building. So I really enjoy working in software background. And I was really lucky to be involved in a number of startups. So I'm a startup type of guy. My limit is about 800 people. Okay, so even though I started out in Cisco, I quickly realized that, yeah, when a company grows too big, I go and look for a new adventure. But really blessed, really lucky, because two of the companies actually went public and then later got bought by, HP and yeah, so, and Nortel. So, so with those first pot of gold, I started investing in China. Okay, so I had places in Beijing, I had places in Shenyang, and those did really well in the middle 2010 or so. Okay. However, China policy extremely volatile. Okay, They'll set 5 rules on you. They'll announce it on Wednesday, and then by Friday it'll take place. Right? There's no way for you to predict. There's no way for you to draw a consistent business plan because policies could change. Okay, so for example, they enforce like your second or your third property that you buy requires a 50% down payment or 80% down payment, right? So that definitely kills off how many people want to buy extra homes, decreasing the value, and you would not know that this was coming ahead of time. You had no time to dispose of your property, right? So I sold all my properties, came back to the Bay Area, started attending a lot of different meetups to see where I should park my money, where should I invest in, right? So later on, I was actually investing in Texas, okay, because properties there make the 1% rule, right? So you generally want to be able to charge 1% in rent of your purchase price. Okay, so if you buy $100,000 home, you want to be able to charge $1,000, and you'll be able to. It's an easy guide to see if you can comfortably cash flow or not, right? That's impossible here. I mean, you go to Dublin, you buy $800,000 home, you can only rent it out for $4,000. That's like 0.5%, right? It doesn't cash flow here. So later on, I actually met a Cantonese couple who bought 72 single family homes in Dallas, and they were managing it themselves, okay? I mean, back when they were buying it, it was like $60,000 a door, you know, $80,000 per house. So it wasn't very much, but you know, you can imagine the kind of nightmare and tax reporting that they were doing on so many units. Okay, so actually, real quick, how many people here is from SARE? Raise your hand if you're on SARE. Okay, so SARE is a Facebook group, young people, you know, but they're all budding real estate investors, and they all want to buy they probably all want to be like this Cantonese couple that buy 72 homes, right? But they quickly realize that's so much trouble. It is so much easier if I buy a single 100-unit apartment, okay? I will have just as many units, but I only have one property to manage. And with that size, I can actually hire a full-time property manager, okay, an office manager to do leasing for me, and a maintenance guy to fix toilets for me. And then I'm free. I don't have to do much, okay? So I got interested in that. And then, you know, being the nerd I am, I started digging into all the numbers, okay? So like I was mentioning before, I like the fact that it's a business. Once you go to commercial scale, it's a business, and your value based on how good you are at generating profit. Okay, the more profit you generate, the more value you create, right? So it's not gambling on the market direction. It's more of like, okay, can you execute on your business plan? Okay, so I like that a lot more. So I started off learning by investing into other syndication deals. Okay, so I think so far I'm in about 4,000 units in apartments in about 16 deals across the United States. I invest in self-storage, student housing, new construction, blind funds, multifamily. I even own part of a plumbing company in LA. Don't ask me why. But I wanted to try out a lot of different things to see what really fits me, right? What is a good thing? Because even though I really like multifamily, doesn't mean that it's always the best investment at any one time. Okay, so I like to keep my options open. Okay, Jack, you want, and this is my partner, Jack. Jack, you want to do a?
Yeah, well, as you know, I recently moved to Dallas. This because so that I can have a bit of
Jack, you want to come over here so they can hear you?
Yeah. Okay, I'll people. Zoom.
Yeah.
Okay. Oh, hi. Okay. Yeah. So I recently moved to Dallas, and well, I lived here for 32 years. Okay, most of you know me for a long time. I'm the founder for Spices Chain. I started out in San Francisco. I have 3 stores in San Francisco, and then Oakland, Foster City, That one you know. All right, and Fremont and Santa Clara. Right. So basically, what I did in the past 20 years is that I'm not just a restaurateur. I know the business of restaurant. It's you talk about diminishing profits. So every time when I open a restaurant, I always have a piece of real estate hedge against myself. Okay, that's how I have rental properties throughout Bay Area. But after I met Tony a few years back, and I saw his numbers and I saw his run writing, man, I was blown away because the numbers, numbers there. I mean, you look at the numbers and if you have a rental, okay, just let the numbers convince you. I mean, you just compare the numbers and you don't need to big stories behind how a big apartment complex like this to run and to purchase. It's very complicated. I'm trying to relate myself to you because I'm a hardworking guy like yourself, okay? And I mean, look at us. You're busy every day, okay? I mean, how would you know about Texas or investment, in other states, unless you have friends or families you went to school there? There must be something, okay? And Tony, that's something that took to Texas. I didn't go to school there. I don't have families there. I don't have friends there. But I wish I would have, I would truly wish that if I had started earlier, much earlier. But it's never too late to start. So welcome you all. Right. Yep.
So before we move on to talking about the Linfinity squad, I mean, I think I just kind of mentioned that, it's my way of, I think there's a general lack of knowledge about what a syndication is and what a multifamily is in the Bay Area, right? I think a lot of us are just starting out, even though people in Texas have been doing this for years, and they're almost all investors there, right? But this is still a pretty new concept to us, so that's why I like having these meetups to kind of teach everybody. And I try to bring in speakers from over there to help educate everybody. So I actually think I have Paul. I think I have Paul on the line. So let me introduce you a little bit about Paul. So Paul Peebles is one of the largest commercial lender in Texas, although he does loans all over the place. So Paul does loans. Actually, can one of you help me out here to bring up Paul's video? I mainly want to, no, I mean, I just want to show him. No, I want to show his little image.
I have to exit the spotlight for everyone.
Pin him.
Pin spotlight. I'm not sure. Spotlight.
And then I grab the slide. The stuff.
Oh, okay, I see. Okay.
Zoom. And then go into the slide. You have to go down.
Stop share.
Stop share.
Okay, there he is.
Yes.
There's Paul. Hi, Paul. So say hi to everybody.
Hey, everybody, it's Paul Peebles in Texas.
Yeah. So as I was introducing, Paul is the godfather of multifamily lending, and he lends all over the United States, not just Texas. Paul easily does $1 billion in lending a year. So, he does all kinds of sizes, small deals, but mostly large deals. He helps us get bridge loans, Fannie Mae, Freddie Mac agency lending, and everything in between. He is your go-to lending broker. So it's an honor to have Paul, and it's getting a little dark here, huh?
Yeah, it's 7:40 here in Texas. And again, Texas is a great opportunity to invest still in Dallas and Fort Worth, Austin, and today I'm in San Antonio, Texas, San Antonio. And, you know, it's amazing how big Texas is. And I came from California back 30 years ago, from California to Texas. And that was kind of the first wave of Californians coming to Texas. And so now the newest immigrant, so to speak, is Jack. And so Jack has left California, and now he's living here in Texas. And so Texas is so large. I don't know if you have an idea how big Texas is, but if you go from Dallas to Los Angeles, the halfway point is you're still in Texas. So that's how big this state is. And it's a great opportunity. A lot of people continue as Jack has come over to Dallas. It's a great opportunity still in multifamily, more in great economics for the state. No state income tax. I saw there was a point that Mark Wahlberg, the actor, just moved over from Beverly Hills to not to Texas, but to Nevada to avoid state income tax. So we are great partners with Tony and Jack. They do a wonderful job. You couldn't have better guys to kind of educate you, and with boots on the ground, with Jack being now here in the Dallas area, and Tony, who's owns lots of units in not just in Texas, but all throughout the United States too, in Indiana, Kentucky, some of these other places that Tony has ownership in. And Tony, is there anything more that you wanted me to say?
No, so I think we're probably about to dig into the nitty gritties of things, but mainly, I know there's a lot of people who are interested in scaling in the future, and definitely, get to know Paul, because, Paul knows the entire Dallas market. A few properties probably changed hands multiple times under Paul. In fact, Paul actually helped us get to purchase in closing the deal on the previous Vanderbilt deal, because the seller actually got a couple of loans through Paul before. So when he was looking for recommendation to get some background checks on us, so guess who he returns to for valuable information, right? So Paul's able to, is instrumental. Paul has so much influence in Texas. So if you ever plan to get into Texas, definitely get to know Paul and his team.
Yeah, thanks for the good words, Tony. We certainly do appreciate that. Maybe one or two things too is that we do probably 1 out of every 3 apartment loans in the Dallas, Fort Worth, Austin, San Antonio area. So we are very active in this space. I've closed probably 6,000 apartment loans over the period of 37 years that I've been a banker. So we're on your team to try to help you out. And Tony and Jack, they do a wonderful job. But if you're thinking about trying to get into multifamily, listen to Tony. You've already shown your commitment to come out today to kind of learn a little bit more about what's going on, but only through Jack and Tony. I have a 21-page white paper report kind of talks about multifamily financing 101. If you want to get a copy of that report, we just updated it for 2023 this week. If you want to get a copy of the report, let Jack or Tony know that you want to get our report, and that's the only way you get it. We'll get it out to you on Monday or Tuesday, but some great details about where we see financing in, how to qualify for mortgages. And again, this is not like single family loans. This is big apartment transactions that Tony and Jack do a wonderful job on. So I'm going to be thumbs up with these guys. If there's any other questions, just contact Tony or Jack and they can get those questions to us and we can answer them for you. But thanks for being a part of the team tonight. And hello to my friend Ashley out there too. And so have a great night. Thanks everybody.
Thanks, Paul. Cool. So moving on back to the slideshow. So, oh yeah. So now I kind of want to introduce the Linfinity team. And then they will be also helping to go over some of the material that we have. So any questions before we go ahead and move on to the next part? Cool. Okay. Well, here are the people who are younger and smarter than I am. So start off, Samson.
All right. Yeah, my name is Samson. I do not consider myself a real estate person. I am actually a battery engineer at an electric aircraft company called Whisk. My background throughout undergrad and my PhD was in chemical engineering. So you might ask, how did I get into real estate? When I was in grad school, one of my classmates, like a bunch of us were trying to look for housing for next year. We're realizing the rents are kind of high, but then we're like, hey, we have some savings. Why don't we see if it makes sense to buy a place and rent it out as a student rental? So luckily, as chemical engineers, we had a little bit of background in underwriting, just not houses, but chemical plants. So we literally just took one of the spreadsheets that we use for chemical plants, replaced it with some numbers for houses, like the income, the expenses, and the financing. And we found out, it kind of makes sense. We could possibly cash flow positive here. So we ended up buying a house. So that was me and one other partner. And we rented it out to 3 others. And yeah, the rental income covered the mortgage, and we were net positive throughout the entire time. So we had that from 2012 to 2019. I actually moved out here in 2016, so it was kind of remotely managed from 2016 to 2019. That's my sole experience when it comes to real estate. So now I'm trying to get back into it. And in terms of my goals, I'm just looking to diversify into different types of properties, not just single family long-term rentals, but multifamily and short-term rentals as well. And yeah, looking into investing out of state because I tried to see if I can do the same thing, same kind of house hack in California. Numbers just don't work out. So yeah, just trying to see what else is out there outside of California. Patrick?
Hi, everyone. Thank you so much for coming to today's meetup. My name is Patrick, and I actually work as a registered nurse. I specialize in emergency medicine and recovery. I also work as a realtor, helping people buy and sell homes up and down the peninsula. And my favorite job above all is I'm a real estate investor. I'm a limited partner in 69 RV units and over 4,000 storage units. Between my wife and I, we own 5 single-family homes. We focus primarily on value add single-family homes where we remodel and add legal square footage to these homes. So by doing these types of value add, we force appreciate the value of these homes tremendously. And from there, we would rent them out to young professionals, sometimes college students, and we also house hack. So what that means is basically we live in a portion of it and rent out the other portion to tenants. And by doing this, the tenants is paying majority, if not all, of our mortgages. So this helps us save more money to reinvest it back into real estate. Let's see here. Let's see, house hack. Okay, yeah. So when interest rates were low, it was a great time. We ended up cash out refinancing majority of our investment properties, completing what everyone kind of knows as a BRRRR. Has anybody heard what a BRRRR is? Raise your hand. Perfect. BRRRR is basically where you buy a home, you renovate it, you rent it out, you refinance it, and you repeat it. So after cash out refinancing our forced appreciated homes, we basically took that cash and reinvested it immediately into 2 short-term rentals, which were completely outdated. And they were all out of state. So my wife and I, we renovated them. We modernized them because they're super outdated looking. We took out the property management that was taking about a 20 to 25% cut. We self-manage it now. We fully optimized it. And we basically increased the prior annual income from $50,000 a year to now a projected $100,000 each property. So I'm pretty proud of what my wife and I have done so far in our real estate portfolio. Right now, my goal is to focus on commercial multifamily investments. As you can kind of already imagine, I'm all about value add force appreciation. And as you kind of get to know multifamily, specifically commercial multifamily, you'll realize that this asset is the perfect spot for value add force appreciation. So yeah, I'm pretty excited for today's meetup. I really want to get to know a lot of you guys. And if you want to get to know me a little bit more, please, my contact information is right there on the slide. And if you have any questions, please reach out to me and my friends. We're here for you guys. Thank you. Is Jamie on?
Hold on. Okay. Hold
All
on.
right. Stella.
Hey everyone, I'm Stella Hahn. I'm the co-founder and CEO of Fractional. So who here likes their friends? Okay, less than I thought. Who here wants to get rich and wealthy? So we help you get rich and wealthy with your friends. Fractional is a full service marketplace for friends and investing communities to co-own real estate together. We started the company in January of 2021. And so far, we've already helped more than 105,000 investors co-own 850 properties, which is worth $135 million in property value. So folks have formed small groups of 3 to 5 to buy single-family homes for long-term rentals, short-term rentals, larger projects in commercial with apartments, self-storage with 30 to 50 people. So really big range. Go pursue your American dream with the people that you want to do it with. And recently we raised our Series A, so the company is now valued at $100 million. Yeah. Backed by some world-class investors like Fifth Wall, National Association of Realtors, Y Combinator, as well as celebrities like Will Smith and Kevin Durant. Personally, for me, I'm definitely a user of my own product, real estate investor myself. So I'm a co-owner in 110 units in single-family LTR and STR, as well as multifamily apartments, primarily in Greater Atlanta, Houston, and Dallas. So I'm all about having a more balanced portfolio. Goals for this year is step on the gas, double down on my existing strategy, and then also explore more in the commercial space. And without further ado, I'll pass the baton over to Ian.
All right, so my name is Ian Cruz. I'm a manager of finance at a venture capital firm at Canvas Ventures. So we invest in early stage startups, and that's kind of a little bit of exposure into the world of limited partnerships as well. Separately, my mom owns a yoga studio, so I help a lot with that, with the finance there, and treasurer of a nonprofit boxing organization at Dreamland Boxing. So a little bit about why I got into real estate. A lot of these things were influenced by my mom because she owns a business. I'm an only child, so I've just naturally been pulled into the things that she's done. Got pulled into bookkeeping just because, she didn't have anyone else to do it. I didn't trust anyone else to do it. So I just, before you know it, here I am, a CPA 15 years later, right? So I got pulled into that, and I got pulled into some real estate stuff as well. She doesn't go to meetups like this. She doesn't introduce herself to people as a real estate investor, but she's made a few moves throughout her investing career, and I was fortunate to be able to help her on some of those moves. So I've done various real estate investments. There, right, bottom slide, talk to me about whatever those are. I don't need to get into every single one, but I'm just going to talk about one investment in particular that kind of highlights, it ties everything together. My relationship with my mom, how I got to know Tony even before Linfinity, and why I got into commercial multifamily. So if anybody knows where Almaden is over in San Jose, I grew up there. We had a home that, you know, I went to Leland High School. After I went to college, my mom started to rent that house out. And for the past 5 years, we've always talked about, oh, we need to 1031 this into multifamily, commercial multifamily. I just kind of vaguely knew that we can do a little bit more with this property. Tony talks about scaling between having 72 different homes into an apartment complex. We had a general idea that that would be a little bit more efficient, right? So we revisited that scenario every single year. We're like, what should we do with this property? We've been renting it out. It's pretty safe. It's in an area with a good school district. You know, we can't really, it's okay to hold it for a little bit, but we always had in the back of our mind, okay, we're gonna go into multifamily or maybe even mixed use because she owns a yoga studio. So if the right scenario comes into play, we could do that as well. And then this, in 2021, that's kind of where, you know, the housing market was hot and we just kept revisiting it. And we're like, okay, we're gonna pull through with this. We're gonna go into commercial multifamily, small, 5 to 10 units in the Bay Area. And that's where I just kind of went down the rabbit hole, reading every apartment, you know, apartment investing book that I could, whether it was David Lindahl's, Joe Fairless, you know, Brandon Turner, all those books. I'm just soaking it all in. Meanwhile, Tony is having his seminars on like much bigger apartment complexes, talking about 120 units plus. And then, you know, I just kind of soaked it all in and got to know Tony through Sarah. And I was super surprised that Tony actually took the time. This is before Linfinity campus. He took the time to help walk properties with me, gave me a lot of advice. You know, I'm more of a number guy, you know, CPA. So I always, you know, would underwrite the properties, but he gave me all the insight on like the bones of the property, the electrical, the, you know, all of these considerations that I never thought of. So eventually we did a 1031 into a 5-unit, and then we're adding an ADU. So we're doing a build to suit exchange. So we actually can hold back some of the money from the 1031. We sold the single family home sold for more than the 5-unit than our purchase price. So then we used extra money to add the ADU. And it was, you know, the right deal for my mom because it gives her cash flow at this stage of her life. You know, when you think about your asset allocation, she's having a hard time being able, like, wanting to liquidate stocks. Like, oh, she has all these other illiquid assets. She needs something that's going to cash flow. So we just swapped out the home into something that would cash flow, minimize our leverage, did something local in the Bay Area. I know Tony, that's why I was so amazed that Tony even helped me in the Bay Area, because he doesn't invest in the Bay Area, but he just really likes looking at apartment buildings. So he loves walking them, right? And you know, so I was super grateful for that. And yeah, so we wanted to stay local so that I could self-manage it. And you know, actually the ADU is being dropped off. It's a prefab ADU because we have to stay within the 180 days. That's being dropped off this week, so that's pretty exciting. And then from there, one thing led to the next. I got super involved into Sarah, and then our Linfinity campus grew, and we've been spending our Friday nights underwriting deals together. So that's where we are. Yeah, that's pretty much it for me. I look forward to getting to know you guys, and you know, after our presentation, feel free to find me.
Cool. Can you guys text Jamie? Zoom? Yeah. Yeah. Because okay, but while they do that, we have another member that's actually dialing in remote. But in the meantime, let me give a little overview of like what I think about investments, right? So like I was saying, apartment is not the end all and be all. It's the best thing at this time, but there's many other options that we should evaluate, right? So as investors, I'm a passive investor first, okay? And then in order to help out all my friends who doesn't know this property, who don't want to have to manage it themselves, I kind of got started to do as an active lead, right? You know, also as a way to help out my friends into getting into something larger. But okay, give me a second here. One of you tell a joke. Yeah, or any of you want to expand a little bit about your background and
I'll say something. Highlight of Linfinity campus. What's been a highlight?
Oh, you know, the cool thing about our group right here is that we meet up every Thursday. It's either at one of our homes or at the Hyatt's. But even afterwards, like it's supposed to be from like 7 to 9, but it literally goes from like 7 to 11, right? So I just tell my wife I'm just not gonna be home. But it's not even just that. Like it started off like just Thursdays. The next thing you know, we got really close, and then it's like, what are you guys doing tonight on Friday? Let's underwrite a deal, you know? And the same thing happened. It probably started at 9 o'clock and it ended at 1 in the morning. You know, maybe 1 or 2 deals. And like we ended that day was like, man, this is the most fun we've had in a long time on a Friday. So multifamily is a lot of fun. Get into it, and we're more than happy to share you our world. So,
yeah.
not a great joke, but
No, so a lot of people, because I do multifamily, I do syndications. A lot of people ask me like, you know, how do you become one, right? And and usually the first thing I tell them is you have to like paying. Okay, that's the first thing. You have to like paying, and because no sane person would pick to do an active when you can easily make almost as much return as a passive. And then you can still. The nice thing about being a passive is, you know, how did I get into 15 passive deals while still working, right? It's because I don't have to worry about them, okay? I invest my money into a passive deal. I'm still chugging away at my programming job that I enjoy. And then I just literally wait for checks. I have no involvement. I don't need to do anything, right? So that's really the nice thing about being a passive. You can continue to do what you're best at, okay? While letting somebody who's really professional at running these things continue to you know, take care of that portion for you, okay? Because you know what, you need to make more capital in order to invest more, in order to have more passive income. If you are like me, you get to a certain age, you just don't want to work anymore, you know, well, you need to have a good starting stash to invest with, so you have enough passive income coming back and you can fire yourself, you know. So okay. So for me, my personal preference, you know, everybody have a different risk tolerance. So, you know, focus on, you know, for me, I'm conservative, I have low tolerance for risk, okay? So my primary focus is focus on assets that do well in a downturn, okay? That means it has a cash flow. That means that if I ever get laid off in a recession, I want to make sure that these assets are paying me, are carrying me through a recession, okay? If it's a negative cash flow, not only do I have no more income, I got to feed that beast to keep it going, right? So, you know, having cash flow is also about having a buffer, having a margin of error, right? So in a downturn, if I'm getting 6% cash flow or whatever it is, that means I could probably lose 10% of the rent, 5% of the vacancy, and still be cash flow positive. And I will be able to wait out any downturn and come out ahead at the other time, right? What you don't want to do is being forced to be sell when the market is down, okay? So those people is usually because they don't have enough cash flow or they run out of capital, right? They run out of reserve money. So you want to be able to survive long enough until the economy gets good, and you are in control of when's the right time to actually sell, okay? So capital preservation, picking assets that do well in downturns is very important for me, okay? Something that doesn't get talked about enough is, don't just look at returns, look at the risk associated with it. Okay, so I know a way to instantly double your money. Okay, go to Vegas, bet on black. Okay, and it's 100% return, right? But you got to think about that risk, right? What is associated with? Well, you could lose all your money, right? That's not very good odds. So whenever you look at certain deals, don't just concentrate on how much return the people are telling you, okay? But think about what is the risk behind that, okay? So a lot of people are saying, cash is king, hoard your cash during times like this. But one thing I want to make sure people understand is we're not greatest at timing when the bottom is, okay? So if you try to time the bottom, well, when is the bottom gonna come? Well, it's a trade-off. When you have a bottom, you have a very high interest rate. That's why it's a bottom, right? And then, if you want to wait for a lower interest rate, guess what? Everybody else is gonna start buying things up. It kind of goes into equilibrium. So I'm a bogglehead. I don't try to time the market. For those of you that don't know what a bogglehead is, it's people who follow Jack Bogle, the founder of Vanguard, who really believes in keeping it simple, just doing index funds. Don't try to time the market. Okay, so, but right now, if you're not deploying your cash, if you're not actually putting it to work, you're literally losing 8% to inflation every year. Okay, so just hoarding cash is, not a good idea. If you can somehow even keep your income at 0%, that's actually pretty good. It's better than, holding cash. Samsung, can you help me bring Jamie back on the line? Because I think she's online now.
Hold on.
Show her video.
Hi, everybody.
Just a
Yeah,
second.
we're trying to bring up your video now.
Thank you.
Did we go to the grid?
Should I go to grid view?
Oh, right there.
Oh,
Here.
oh.
Yeah.
I guess we could. There we go.
And then can you pin her?
I think if you start talking, it'll show you.
Just
Hello.
okay, there you go.
There you go.
All
Oh,
right.
nice. Hi, everyone. Oh, can't see anyone here, but okay, awesome. Yeah, sorry I can't be there today. Had some prior family priorities, but hopefully can make the next one. But hi, everyone. Just want to do a quick introduction. My name is Jamie. I am also part of the Linfinity squad. So thankful for Tony, for hosting this. A little bit about myself. I was born and raised in the Bay Area, specifically in Fremont. Graduated from UC Davis about 4 years ago, and now I do finance at DocuSign, specifically in sales strategy. After UC Davis, I moved straight to Sacramento, and back in 2019, I thought, oh my gosh, why am I always renting? Why is all of my paycheck going to rent? So I wanted to look into house hacking first in Sacramento, but the pandemic happened, so I just moved back home. But I still was able to land my first home in the Bay Area back in 2020. And then I wanted to explore different asset classes. So starting from long-term rentals, and then the year after acquiring my first short-term rental in Scottsdale, Arizona. And then after that, bringing it back to 2022, I met Tony at SareCon in Long Beach. And I was just really impressed with his portfolio with commercial multifamily, and how he was able to really outperform the market that we're currently in right now. So I think that one of my goals this year is to, one, underwrite with confidence. Really impressed with how Tony's underwriting skills are, how conservative he is. So I definitely want to take that into my practice and my future underwriting, but also hopefully becoming a GP or an LP for a plus 80 unit commercial multifamily project, focusing on value adding, increasing margins, and just learning the overall operational excellence. Yeah, thank you. Thanks, Tony, for letting me jump in, do introduction.
Oh no, definitely. Cool. So yeah, we'll talk about, we'll start off by talking a little bit about the market and where things are. So to lead that off, Samson.
All right, so the thing everyone has been talking about when it comes to today's market is inflation. Inflation, like everything's getting more expensive. Year over year, it's 8%. And just this past month, the CPI, Consumer Price Index, increased by 0.4%. Yeah, that is pretty high, especially compared to the prior years before. So the way the Fed tries to fix this is they have this one hammer. It's called the federal funds rate. So what this does is it indirectly influences the amount of money that's in circulation. If you think of basic supply and demand, inflation means the value of your money is going down. So you want to limit the amount of money that's going around, so you decrease the supply of money. And what the federal funds rate does is it makes it more expensive to borrow money. The chart you see over here is the federal dot plot. Every time the Fed comes together and decides on how much to raise the federal funds rate by, they also make projections for the next few years on where they expect the funds rate will land in the future. So that's all the dots that you see. Each one of them is one projection. So the entire committee will each of them makes their own projection, and the blue dot is the median. What you also see on this curve is the SOFR forward curve. The first time I heard Tony bring this up, I'm like, SOFR? What does atomic number 16 have to do with? Yeah, I'm a chemical engineer. I didn't know this. So I looked it up. It means secure overnight financing rate. Think of it as, well, technically it means the amount of the rate at which a bank can borrow money overnight. And that money is basically the treasury, backed by the treasury or collateralized by the treasury. And you can kind of think of it as a short-term interest rate. And when it comes to expected rate increases in the next couple months, on November 3rd, the Fed is going to meet again. The expected increase is going to be 0.75%. And then in December, it's another 0.5%. So there's still some more room for this interest rate to increase. And if you look at the SOFR curve, increases could continue on throughout 2023. And it's not until 2024 when we will start seeing a decrease. It's kind of difficult to wrap your head around what these numbers really mean and what the intent of the interest rate could be. I think it was James Eng of Old Capital. He called 2.5% as the neutral line. So if the federal funds rate is above 2.5%, what it basically means is the Fed is trying to push the brakes on the economy, slow it down, and that's to get inflation under control. If it's around 2.5, it's neutral, just letting the economy do its thing. And if it's below that, it means it's trying to boost the economy. So what does this mean for, yeah?
So what's the source of the data?
The source of data?
This is
Do you know what it is?
So you can get it from Fred, which is a government website. And you can plot basically the 1 month SOFR versus the dot plot versus all that kind of stuff. It actually has a lot of great data on there. So 10-year treasury, historical, all that kind of stuff. So the SOFR is really, tracks the federal fund rate pretty closely. So every time the federal fund rate moves, this also moves. So the Fed fund rate right now is about range of 3 to 3.25, and then the SOFR is right around there. I think SOFR currently trades at about 302. So yeah.
The SOFR is just a name of the of interest rate, but where's the is the data from the government or?
Yes. Yeah. So the dot plot, okay, the dot plot is actually on every Fed meeting. They would actually also release. So for all the people in the Fed committee,
like 30 of them, each of them would put a dot on where they expect to go. And then this dot plot compared to where they thought a year ago is it went way higher, right? So, but yeah, at least kind of gives you, you know, some light into how they're thinking. Okay, so typically they would keep it up there. Okay, so once they reach a high, they usually will keep it up there for anywhere from like 4 to 6 months. But they can't keep it there too long. They have to drop it because it not only is going to cause a severe recession if they keep breaking it for too long, it will also cause a global recession. You know, it's not just a US. So they talk a big talk. I think the Fed doesn't know what the hell they're doing. But you know, at least you can kind of see what's the next trend for the next 6 months, and think about like how do we still try to adjust to this new reality.
Yeah. So what does this mean for interest rates to you as a consumer? Typically, the way interest rates are for consumer loans is they have this index rate. The SOFR is an example of one interest rate of one of these index rates. And then there's plus a spread, and that spread is basically the interest that the bank would make on top of it. So yeah, the residential interest rate rose from 3% at the start of this year to 7% now. And that's because there's a spread added on top of this federal funds rate. So we have this situation where we have record high inflation and also this rising interest rate. So how can we benefit from inflation despite the higher interest rate?
I just want to throw in one extra thing here. One thing that's not shown here is the Fed actually has 2 hammers. Okay, one hammer is the interest rate that everybody thinks about. The second one is they actually buy mortgage-backed securities on the open market. Now, what they have done in the past half year is they really slowed down at the rate which they were buying to almost a standstill, right? So, you know, your 30-year mortgage, your 10-year treasury note, guess what? They're not buying it anymore. And it's only the public market that's actually out buying these MBS now, right? So it's a lot less people. Because there's a lot less people buying it, your 10-year treasury rates and the associated 30-year mortgage is now going up as a result. That's the second thing the Fed is doing that people usually don't see. But now we know this is how the situation is. How can we benefit?
So I got a pretty fun interactive slide. So, you know, yes, raise your hands. No, you know. Where should we put our money? Should we hold cash? Who likes to hold cash? Unfortunately, you're losing 8% a year to inflation right now. So we don't think cash is holding cash is a good idea. I'm not saying spend your reserves. I'm saying look for investments with your cash, extra cash. CDs. Who likes CDs? Yeah, you like CDs?
Yeah, that is part of the foundation.
Right now, you're getting about 3.5% for the next 5 years, roughly. All right, inflation is still about 8%. I-bonds. This has been a huge topic lately. Who has an I-bond? Who likes I-bonds? Yeah, right. I say it's just okay. Right now, it's about 9%. But coming November, it's going to decrease to about 7%. And unfortunately, you can only invest a max of $10,000, and the rates fluctuate. I mean, what if you have $100,000 sitting in your bank account right now to invest, separate than your reserves? You're losing money to 90,000, right? And then starting in November, you're losing money again. Social Security. No? No, I don't. All right, just kidding. It's not really an investment, but it was asked. Stocks. It's a great time, right? Who's a millionaire in stocks in today's market? No? Who likes stocks? I like stocks. Yeah. Come on, be honest. I like stocks. There you go. I do like stocks. Don't get me wrong. But right now, it's super volatile. And actually, there's a lack of control. There's actually somebody who's a stockbroker who kind of told me that there's, compared to real estate, there is a lack of control. Unless you're really into stocks, you really don't have much control over, is the dip going to happen tomorrow? Are we going to keep buying the dip, right? Retail. Who likes retail? Who likes shopping? No? Okay, thanks for being honest. No, it's very risky during a recession, right? Industrial? Big talk about this, yeah? No. There's talk about work from home, and there's been a number of deals that's been falling out of closing lately.
Let me give a little color on this, why, so industrial is actually one of the hottest commercial assets to invest in, okay? However, in a higher lending rate environment, the trouble with commercial industrial is that it is hard to push loans across, okay? So if you compare something like a commercial multifamily, you always have Fannie Mae and Freddie Mac there as your backstop. They will always loan because they are actually mission driven as dictated by the government to help residential. Okay, so on the residential side, they will always buy MBS, right? Okay, and then on the commercial multifamily side, they will always provide loans. Now, if you're doing retail or if you're doing industrial, right? Fannie Mae is not there to always guarantee that you will get a loan. They're not there. So what you end up with is if the private lenders feel like, in the current market, I don't want to lend because it's risky, right? You might actually end up with a very, very small pool of lenders, which really drives up the interest and lowers the leverage that you have on the industrial. And that's a kind of deal falling out. I mean, I was talking to my lender the other day, and he had a 60 million and a 120 million loan for industrial that just fell out, right? Because they will just change the rates and leverage on a dime right before you close. And those deals fell out. So it's challenging to do it right now. So what we're saying here, what Patrick is also saying is, when taking together with the risk of execution, it's not that great. It was really good 6 months ago. Okay. When everybody was like,
what kind of properties are in that industrial project? Like warehouses, office buildings, or is office building part of that?
Office buildings, warehouses, yeah.
So office tends to be in its own bucket. Okay. Industrial is more like your logistics, your storage, sometimes in light manufacturing. So you will see like a lot of these things here. But the main difference is offices, they don't have warehouse space. So those are pure play offices, whereas industrial will include usually like a dock or something like that.
Any other questions? A few more. Single family homes. Who likes single family homes? Yeah? No. We're seeing home values decrease right now. I'll explain a little bit more what I mean by based on comps in a little bit. But it's also slow to scale, and I'll kind of touch on this a little bit. I have a few more notes I'll share afterwards. Traditional self-storage. I have over 4,000 of them as a limited partner. Who likes self-storage? Everyone's talking about it's recession-proof. Traditional self-storage. They're just okay. And I say that because on average, you're getting about an 8% return. There's low value add opportunities in just traditional self-storage. Okay. Commercial multifamily. Who likes commercial multifamily? Come on, everybody should be raising their hand up if they're here today, right? Obviously, this is maybe the right answer. This is a no? It's a trick. I know, right? Yes. All right. It benefits from rising rents, and we're getting about in certain markets, we're getting an average of 13 to 15% annual returns, and we have a further slides later on to kind of express that to you. I kind of want to add a little bit more to this, and it's in my phone. But one takeaway from this slide is that we need to continue to use our money wisely That's like the big takeaway from this slide, right? We all made a great decision to be here today and learn about real estate to make our money work for us passively. I want to give you guys a few perspectives, all right? When you spend the time to underwrite one deal, it could be one single family home, or can it be a 100 unit multifamily, right? Who likes cash? Who likes cash flow? You're crazy if you don't like cash flow. Come on, right? Well, if you raise your rents in your single family home by $100 a month, right? What does that get you? That gets you times 12, 1,200 per year. Well, let's say you have 100 units, you raise $100 per unit. What is that per month? That is $10,000. Times 12, a whole year, that's $120,000. Think about that, right? And let's talk about risk.
Wait. But that's actually not the biggest thing.
That's not. I actually did not want to add the whole cap rates and dive too deep on that, right? Surface level, right? But you're absolutely right. That's kind of where the value add play is, where if you were to kind of multiply it in terms of the cap rate, it comes out to be a huge number in terms of return, right? And then you do a cash refinance and put that money back into another multifamily to make you even more cash flow, right? But surface level, right? Let's talk about risk, right? Because right now it's very risky, right? We're in a recession. Well, when you have one tenant leave your single family home, you're 100% vacant. Who agrees with that? When you have one tenant leave your 100 unit multifamily, you are 99% occupied. Put that into perspective. Thank you, everybody.
So I know a lot of people are stressed about rates, but we're here to talk about how to combat that because, you know, diamonds are made under pressure, so there's still a way to make this work. So actually earlier on the drive here, I saw a billboard from Loan Depot and it was like, we're offering residential interest rates at 6.9%, dare to beat that. You know, so that's the situation we're looking at in residential. Samson covered it earlier as well. Silver lining here is that commercial is still relatively cheaper, around 5.8%. So that is definitely favorable for commercial multifamily. And right now, because of where things are heading, it's actually a little bit more buyer friendly in the sense that, you know, for each deal that's coming out, there's not a flock of buyers out there all overbidding each other. So that actually gives you a little bit more leverage. Something that's a little bit tricky is that sellers are still a little bit used to what was happening in the pandemic. You know, some of them still might be a little bit delusional, which is why as a buyer yourself, you have to have really strict metrics for what you're aiming for. So you want to think about, you know, what are legit and great outcomes I want to have in terms of the cap rate that I'm aiming for in the neighborhood or the city that I'm buying in, or the cash on cash. And you basically want to almost like hard code that and then adjust the purchase price to see how you can actually make that deal work and push that back on the seller. So example here is, you know, 400K house in a Bay Area if you're aiming for a really good metric in the Bay Area. And now with interest rates going so high, it's fluctuating a lot. You can remediate that by getting a fixed rate loan. So you can essentially, you know, override more peaks, more jumps, where we know in November it's going to increase again. Later on, it's going to increase some more. So you want to get a fixed rate loan now, or buy a rate cap so that, you know, you're basically limiting the threshold for how much bigger that interest rate could jump into. Another good hack is that sometimes you could assume an existing seller's loan. So they might have been able to get an interest rate during the pandemic or before the rate increases something that's lower for 4%. You can negotiate that or see if you can get that in your deal, assume their loan at that lower interest rate. Another way is to just put in more cash now, buy it with more equity. And as Tony was talking about earlier, you know, the rates are going to increase forever. So put in more down now, do the value add, you know, increase the rent, get it to market rent, you know, rehab the property. And then later in a couple of years, once the interest rates are lower, it's more stable, and you've already, you know, reached a certain level of outcome on the deal, you can refinance, get more money out, that gets distributed to you, the LPs, however you've structured it. So that's a really good angle to go as well. And then the last part is prepayment penalties. So a lot of lenders, the loans, they obviously have investors that are buying into the loans as well. So they are looking for an outcome as well, and they obviously don't want you to exit out of the loan really quickly. So a lot of lenders will actually penalize you if you do a refi or sell the loan early. So usually it's depending on what kind of terms you have. It could be 7 years, 10 years. If you refi in the first year, they might penalize you like 5. There's like 5, 4, 3, 2, 1. Different, essentially, like depending on how long you're holding onto the loan, they will penalize you less. So you might want to essentially pay more upfront to not have a prepayment penalty. So that gives you more flexibility to refi once the market is better, or have essentially less of a prepayment penalty. So yeah, those are the main points.
Yeah, so one more thing that I think you see pretty common, maybe in some of Stella's deal, that you can actually nowadays on single family homes or on small multiplexes, you can ask for seller financing. Okay, and that's a great way to increase your leverage in this environment. Now, what I wasn't expecting is the commercial multifamily sellers are actually opening themselves up to this option as well. So we are actually seeing cases where the multifamily owners have owned it for 4 years, 5 years, or whatever. They have made plenty of money, and they're willing to take a portion of that profit as a loan to you, okay, to help you increase your leverage, for you to make sure you close on the deal. Okay, so it's really a buyer's market out there. There's a lot of demands and concessions you can make. Some other things that you could also ask the seller now is like a rate protection. Okay, meaning it's like, okay, so right now the rate is at 5.8. How do I know that 1 month later, by the time I lock, it's not going to go 6.5? So you would actually write it in your offer that in the event that this rate goes to whatever, the seller will cover whatever the extra cost to buy that rate down to the agreed upon rate. And this protects you as a buyer, right? And you can actually start demanding these clauses, right? And so these are all ways that you can protect yourself even in a very volatile rate environment. Yeah, and you can even, so Fannie Mae also offers a fast track rate lock program. Okay, so usually you don't lock the rate until like about 3rd week after it's gone through the second loan committee. But now on the first loan committee, which is like usually less than a week, okay, you can lock the rate for an additional fee, but it really reduces the risk for the overall.
You're saying about locking in the rate. What if it also has a chance of going down? Is there a way for you to protect yourself from that, or is it only in a sense if it's only going up?
So the Fannie Mae one. So Fannie Mae, because when we get loans, we don't go through like a bank which then sells the loan to Fannie Mae. We get our loans, commercial loans, directly from Fannie Mae, and that expedited loan program allows for a reset. So if the rates drop lower, you could actually get a lower rate. It's awesome. So Fannie Mae loans are really the Cadillac of loans. I mean, you get up to 5 years or 10 years of interest only, which really helps out your cash flow while you're renovating and all that kind of stuff. It's non-recourse, okay, meaning that you're not liable if the value of the home falls below the loan. Normal bank loans and everything kind of stuff is full recourse. You're taking on responsibility for the delta. In Fannie Mae loans, it's non-recourse. Okay. Fannie Mae loans also give you 2 supplementals. So further down the road, once you have improved your operation, you don't have to refinance the entire loan and incur a penalty. You can literally just take out a second loan, third loan, while keeping your original loan and maturity intact. And then you can, so on one of the investments I had, it was it was $100 grand investment, but I got about 25 grand of cash flow back And on the supplemental, the investors got another 75 grand back. So we got our entire investment back and we haven't even sold the property. It is still cash flowing. I mean, your return is infinite at that point. You got all your money back because you have no money in here. So that's something that's really an option nowadays because you're putting in more down payment, but you can take out supplementals down the road.
All right, rents may be dropping. That's one of the more recent headlines, and this is after a huge run up in the past year. So to address that, people have, so it's pretty uneven across the US. We're seeing areas like San Francisco, Tampa, Las Vegas, they're getting hit a little bit harder. And then it's also uneven depending on class. So on both ends of the spectrum, there are people who are getting hurt. They call this a white collar recession. We're seeing tech is getting hurt pretty bad. On the opposite end of the spectrum with inflation, you're having people who previously were living paycheck to paycheck, maybe having trouble with increased food costs, increased gas costs to be able to pay their rent. So you're going to see more delinquencies and things of that nature. But Tony did a good job of explaining why he invests in the Class B apartments. And furthermore, he believes that the Class B workforce is pretty stable. So their pay is going up with inflation. And with higher interest rates, a lot of the new construction has stopped. So that pushes the Class A down to the Class B. So I invest in Cincinnati over a 1 year period into June and July. Rent had gone up over 40% and it's dipped a little bit since then. They're not going to be hit as hard. And as far as rent prices dropping, part of that is also cyclical. Q4 is typically when less people are moving. I know Tony in Dallas, he's seeing 27% rent growth in Irving and 22% rent growth on renewals. So, and Irving is an economy that is heavy on logistics and medical. So they've been pretty strong throughout. So covered all those. Yeah, and then with home prices, I mean, even though home prices are going lower with higher, I think a lot of people have seen the monthly payments have gone up with higher interest rates. So there's still a pool of renters that are that need a place to live.
Cool, thank you guys.
So going back to the point that Ian has brought up, so very quickly, if we look at the different asset classes, right? We focus on what's called workforce housing, okay? Not places that you guys want to live, but where the normal Americans live, okay? Always remember, when you go to Class C or Class B, right? It may look more messy than what you want to, but it's not what you want. It's what makes money, okay? So in terms of the workforce housing, it's gonna be, so think of your warehouse workers, think of your blue collar workers, think of, people who work, there's like 50,000 people that works in the DFW airport, right? In a big hospital, there's actually, other than just the white collar doctors and, nurses that get paid a lot of money, there's a bunch of like people that helps to clean up and do transportation, that provides nutrition, that does all that kind of stuff, right? And those are the kind of tenants that we rent to in a Class B, okay? And guess what? There's a whole new labor shortage, okay? Just go around and look at all the signs that's looking for help. My favorite restaurant is on a limited hours because they can't find enough help, okay? It's terrible. I mean, Phil's was closing at 6 o'clock. I got pissed off. Where am I gonna work? Phil's closing at 6 o'clock. It used to open until 9, and they said that they had labor shortage, right? And that was a thing that Ian was also bringing up, right? So they're raising hourly pay from $15 $20, $25, right? And some of the construction jobs or whatever, they're doing $30 and nobody, then they're not getting enough people. Now, who are those people that are benefiting from these, really hourly income increases? Is not the tech people that's renting the class A's, okay? It is the workforce housing people. And their income has gone up so much that's how they're able to afford the rent push. Okay, so it's a very interesting, dilemma. It's so different now. And then if we ever have a recession, right? And those people, those college newly grads who thought that they're gonna get a really 400K job at Google or something like that, guess what? They're hiring freezes. So people are gonna adjust their lifestyles, right? So instead of living at a $4,000 a month place, they're gonna go look for Class B places to live at. But there's only so many Class Bs. They're not building any more of those. Whatever was built in the 1980s, that's it. Okay. All these new stuff that they're building is all the 300 plus units, brand new big community, mixed retail type of stuff. They're not going to waste their time to build a Class B that has a much lower density, right? So you have more people, especially in places like Texas, right? You have people who can't afford California or New York type of pricing, and they're all squeezing to places that's more affordable like Texas. And they're all looking for Class B. And there's not any more of that. That's how we are still seeing rent increases, because the demand is there for the same set of housing. Yeah.
Yeah, quick question. So, like according to your experiments, do you see as many opportunities, like value added opportunity in the Class B property, as in the Class C buildings?
It's harder to find. So this syndication is a new concept to people in California, but Texas, they've been doing it forever. Okay, they've been doing it for the past 20, 25 years. A lot of the apartments there has probably been upgraded 4 times already, right? So in terms of like a true value add, when we say value add, we're talking about a light turn, okay? A light turn of maybe, $4,000 to $5,000 per unit type of light turn, okay? They are harder to come by, okay? So believe it or not, a unit that's belongs to somebody who has had it for 20 years, who hasn't made any renovation, it still looks old, those go for more money than the ones that have already been renovated, because there's more potential. Yeah.
Okay, Tony, next question is on. In Ken McElroy's book, Advanced Guide to Real Estate Investment, he mentions that there's a ratio for every tech collar or white collar worker, 4 blue collar to support that.
Yes.
Do you agree with that ratio? Number one. Number two, how does the economy impact that ratio and investment in the sub-market in our area?
Yeah. So I agree with that. So for example, when Toyota actually moved their headquarters to Dallas, okay, you saw that effect. There were so many more jobs, ancillary jobs, so they have high taste, right? They want to renovate their homes, they want to eat at good restaurants, they want to do all this kind of stuff, and they're willing to pay so much more, and it brings so much jobs, right? So it absolutely does. And you can see something like that in Austin, So you have high tech workers, high paid people working there, but it pulls the rest of the economy with them. Like I like to complain about how my contractors probably making way too much compared to before, because there is that kind of demand for the middle class labor force.
Do I understand correctly then on these Class Bs that because they're quite a larger square footage, then they're not quite as dense as new properties that are being made? That's the motivation for people getting into them more?
No, it's mainly the rent price difference.
The rent price.
Yeah,
It's cheaper.
it is. Yeah, so people are, you can see a pretty big drop off between the Class A and Class B rents, right? So usually these two classes don't intermingle. So that's also another nice thing. So you have a Class B, but you're not really competing with Class A. They're Texas built like Class A like there's no tomorrow. When they build, it's literally like, boom, 30 buildings. And then if you own Class A, well, that's going to totally dilute you in terms of like, you know, how many renters you, and your ability to fill it up. But it doesn't,
Target segment.
yeah, but it's different. Okay. So moving on. So the typical investments I like that are downturn resistant, commercial multifamily, triple net medical, because you know what, even in a recession, people are still going to see doctors, and especially pet hospitals. They still do surgeries, all that kind of stuff. You know, they treat it like family, right? So, but I only want to do triple net. I don't want to own hospitals. Okay. Self-storage as well, like what, you know, Patrick was saying, right? Industrial does well as long as you can get the loan. Okay, the lending environment has changed a lot, but typically I like industrial. Okay. So out of these, you know, so out of all the options that we kind of looked at, I still think that commercial multifamily is good for the recession. Okay, it actually benefits from the inflation. When everything else is going up and I jack up like rent by $400 on a poor tenant, he's like, oh, that's kind of expected. Everything else is expensive. So I'm able to have it go with the inflation. Okay, and actually don't get much resistance from it, right? So you want to invest in something that benefits from inflation. If you were to invest in stocks, fine. But what does well in a recession? Believe it or not, Safeway actually does really well. Okay, during COVID, right? You saw everything kind of shut down, but Safeway was still open. Safeway still had tons of people because people will stop eating out of the restaurants during recession and then they will cook, but they need to go buy groceries in order to cook. Okay, so these kind of places actually do well. You know, if you were to pick equities, stocks, that's the kind of stuff I would pick. Okay. And then the other thing is like apartments has really good benefit. It has a good stability in terms of occupancy during downturn, right? But it also has potential for upside because you can renovate it, you can improve it, you can increase your income. Okay. So frequently you hear about like, oh, this big developer just bought like a $50 million property. Oh, this guy, you know, this pension fund is invested in this 300 unit apartment or something like that. And then for us, we always think that that's like VC money, or that's like, you know, private equity that has nothing to do with us, right? But that's simply not true. With a syndication of us crowdfunding and pulling the money together, we can buy things that are much larger, institutional quality. We can scale up, right? We're not stuck at buying things one item at a time. You know, we're now buying at Costco discount prices instead of like buying individual ones, right? Okay. So we talk about downturn resistant. I'll show you economy of scale. There's significant tax breaks, okay? So thanks to Trump. So first of all, your appreciation is taxed as a long-term capital gain, right? So 15%. And then Trump actually passed a law while he was in office where 20% of the profit that you get from a real estate LLC, this type of pass-through entity, 20% of that profit, you don't have to pay taxes. Okay. And then you have the bonus depreciation. Usually your property depreciates over, I think, 26.5 years, right? We can do what's called a cost segregation study that says like, oh, windows actually depreciates faster than the land, right? And then the walls then depreciate faster, all that kind of stuff. So once you have categorized them, you can accelerate the depreciation of that, okay? Into just, you pull everything over 26.5 years into 1 year, okay? And then you used to only be able to do that on 50%. With Trump, he changed it to 100%. Who does that benefit? People who invest in real estate, AKA Trump, right? But we happen to be, he literally slipped this 4 hours before that tax bill was written. Okay, that 4 hours before that tax bill was passed. So who does that benefit? Well, it happens to also benefit us because we are set up, the real estate is set up in the same structure, right? LLC, pass-through entity, right? So you can get bonus depreciation. So on the most recent property that we did, for every 100K that you have invested, you can get 75% of that as immediate depreciation. So 100 grand and you have a 75 grand write-off right away. Okay, you can use that to write off any other gains that you have from rental activity and other passive activity. So one thing that some of my investors did is when they sold Arbor Terrace in the beginning of the year, they have a bunch of income from profit, right? And then they invested into Vanderbilt, and that depreciation loss from Vanderbilt offset a significant part of their gains for that year from Arbor Terrace. Okay, it's a 1031 without having to do a 1031, without the timing restrictions. It just has to be the same calendar year, same tax year. It's super flexible, and whatever you don't end up using carries forward to the future years, right? So that 75 grand in write-off, if I'm able to generate 10 grand, 20 grand of cash flow to you a year, guess what? For the first 4 years, you don't pay anything, even though you got the money, right? And then when we sell the property, whatever gains you had, you can write it off against another property. And then you can just keep rolling like that. You can keep deferring your taxes. Okay, so it's not fair. Ordinary people don't understand it, don't understand how great the tax benefit is, but this is why the rich people get rich this way, because they have affected the tax code. Okay, so don't whine about it. Don't whine about inflation. How can I make money in inflation? How do I make money like they do? You know? Yeah, sorry.
In terms of like having like an LLC versus, you know, a lot of you guys have your day jobs too, or like, so like working in tech and stuff, our tax is like so high, right? Like I don't know how to look at it. So like, I guess I'm trying to figure out how also like investing in real estate, is there a way to get some tax breaks in my actual W-2?
It's hard. So, and the reason between that is there's a difference between like mainly 3 categories of income. You have your ordinary income, you have your capital income, and then you have your passive income. So unless you're a real estate professional, the depreciation cannot be used to offset your W-2. Okay, if you're a real estate professional, if one of the spouse is, okay, then he can claim that as that the 75 grand depreciation I talked about can actually be claimed to deduct against your ordinary income, your W-2 income. But otherwise, the passive loss can only be used to offset passive income bucket. Things like your rental income, things like your other syndication income, that kind of thing. So is there a way? Yeah, quit your W-2 job like I did. but no, you know, it's a joke, but you have to really build up your chip stack before you're able to do that, right? So I worked for a while so that I have enough liquidity to do the things that I want to do. So no, I mean, don't underestimate the value of your current W-2, because you also meet people through it who could be helping you to build your multifamily or your real estate in the future. They could become your investors, right? And yeah, like I said, you're building up your chip stack. So W-2 wise, I mean, you should always, there's a few things that you should always be doing. You should always be maximizing your 401k, you know. You should always be smart about how you do donations. Okay, there's ways to offset, but I can't go into that. But yeah, talk to me, there's other ways to help. I'll take one more question, but we had to kind of move on. Okay, but let's spread it out. Yeah, go ahead.
It's a question about this when the property is sold and then the house goes right as a LP.
Mm-hmm.
And as benefit house.
Yeah, so all the gains, all the benefits, the tax benefit I described applies to LPs. Because basically at the end, all the gains and losses from the LLC is passes through to your personal income. So you file on your personal income tax. At the end of every year, you get a K-1 partnership statement that talks about the profit and loss, and you claim that on your personal individual income.
So there's no way to do that 31.
You could, there's two ways you can do a 1031. Like I said, you know, if you buy in another property that same year, you can use the accelerated depreciation to offset the gains that you have for that year. Okay. Or syndications can do 1031 to a new deal. One caveat, the same group of people have to all go. Okay. Now, what's the problem with that? If you invested 100 grand, I gave you 200 grand. And I said, can you please don't touch that 200 grand? Don't buy that Ferrari, okay? Please invest it back into another 5 years. Half of the people will do that. Half of the people says, I want to go buy a boat. And then it's hard to convince a large number of people to all don't touch that money and all go together. But it can be done. Yeah. Okay. Let me just kind of keep going. Yeah, so predictable cash flow, it's a business. You can model it. If you execute a business plan, you can achieve the things that you have projected, right? The key is to project the worst of everything. Don't assume you're gonna get like 10% rent growth every year, okay? Don't assume that when you sell, the market is gonna be the same. I always assume the market is gonna be at least 10 times worse by the time I sell. So if the market is 10 times worse by the time I sell, I hit my target. If the market is the same, guess what? I hit a home run. If the market is better, then we really hit a double home run. Okay, but be conservative in your assumptions. And then, you know, you'll be able to mitigate most of the risk, okay? And then lastly, it's like, yes, it spreads risk, right? So you now have 100 units, 200 units. If 10 people don't pay, you still collect 90%, okay? Also, with a single family or rental, you're putting all your nest egg, you're putting 300 grand, 400 grand of your own money into a deal. If that one doesn't work, or if it's dropping value like it is now, you're screwed, right? That was your whole thing. But in these syndication deals, you're spreading the risk with other investors. You know, you're not putting all your eggs in one basket. You're spreading it out with everybody else, and they're kind of sharing the risk. So that's one good aspect of it. Okay. So syndication, what is syndication? Believe it or not, it's like a VC fund. Okay, you hear about all these startups having these VCs, you know, getting like a $3 million angel fund or $10 million round, $25 million round. Where did that money come from? You think there's one guy with $25 million doing investing? No, VCs are also a syndication style fund where the high net worth people put in $1 million each. And together they form a large acquisition fund to go invest in these companies. They're all crowdfunding. This crowdfunding has been around forever. Okay, syndication is just for the ordinary people, not the high net worth people. Okay. So we're SEC regulated 506B, 506C entities. Okay, 506B means that you can have non-accredited investors. Okay, 506C is only for accredited investors. Okay, so we do pretty much all 506Bs so that, you know, I mean, not everybody is like, you know, super wealthy, right? But, you know, we're allowed 35 non-accredited spots. So people, even when they don't hit that threshold, they can still invest, right? So we have this for the general public. It's not just for select few, right? Okay, so members are owners of the overall LLC. So one thing people confuse is like, oh, 100 units. Does that mean that I buy 4 units that's actually close to the road, and then this guy buys like a block of 10, you know, at the south side? No. We all own it together. And then the amount of profit and distribution that you get is proportional to the amount of money that you have invested in the overall investment. Okay, same thing for your voting rights. Okay, We don't have a special thing. So this is typically how it looks like, okay? So let's say we have a property that we bought. We will create a singular property LLC for it, okay? This protects us from lawsuits, okay? From frivolous things that, so this protects you. You can never lose more than you ever put in, okay? They can't come after you, okay? So the LP passive investors invest and become part members of the deal, okay? According to their share. The GP sponsors, who is basically Jack and I, we're the responsible party for the deal, right? And maybe, with one of these great people who will also become a sponsor in these deals. And together we will run the GPs are responsible for running the property, the daily operations, okay? But in my deals, I don't have a special class for myself, okay? So I don't do like, because I am like the GP, I have 10 times the voting power that you do, okay, or something like that. No. When we also put in our own money, right? So if we find a good deal, we're gonna put our money in there because it's a good deal. We also want to make money, but we invest our money as an LP. Okay, so we have the same class share as you guys do, meaning we don't have any special privileges. We don't get to override your decisions with a majority, voting power or anything like that. Okay, so we invest like you do, but we as GP sponsors are responsible for the operations of this property LLC. Okay, and then, so we probably account for maybe 40% of the total raise, right? And then the remaining is Fannie Mae and Freddie Mac. Okay. So let me ask you, who is the biggest investor in this deal? Is it Jack and I? We usually put in 600 grand or 400 grand or something like that. Is it us? No, the bank is the biggest investor. If you're ever worried about our due diligence on the deal, okay, trust that the bank goes into way more detail. Before writing that $18 million check, they will do much more due diligence than you guys will even think of, okay? They run full criminal international Interpol report on the sponsors, okay? To make sure there's no criminal records or anything like that. They check our bank balances. They check our qualifications. They check the property. They send appraisers. They send inspectors, okay? Foundation people. They check out plumbing people. They inspect the rent rolls, the financials. They check everything. They're very, very thorough, okay? Before they give you that check. Okay, so they're actually the biggest investors. They really don't want you to fail, okay? But to them, the property is the most important part. Sponsors are secondary. As long as the property is good, they know it will operate well. Even if you have bad sponsors who says, "Oh, this is too hard for me. I'm gonna go to Florida, not think about running the property." The bank knows that they can always replace a sponsor with somebody else. As long as the property is good, it will perform. As long as the business plan makes sense, it will perform. All they have to do is slide in their own sponsor. And the LPs also get a voting share as well. So you guys will get to vote on, if the GPs are not doing a good job, there is a clause in there. I mean, I usually don't invest in a deal unless there's a clause in there where I said I can vote out the GP if they're underperforming, if they're derelict in their job. Okay, there has to be a way for me to replace them. Okay, so LPs have that right. Okay, and then LPs also get to vote on, should we sell the property? Should we refinance the property? Okay, maybe some people want to hold on to it longer and keep enjoying the cash flow. Maybe some people just want like a, I want to get my money now, right, type of thing. Okay, so LPs have a right to vote, and we don't have an overriding share. Any questions?
Quick question.
Mm-hmm.
If some of the investors wanted to monetize their initial investment, does LLC have
Mhm. Yeah, so the question is, if someone wants to sell their share, can they dispose of it somehow? Okay, so yes, but note that because this is a private offering, this is not a public security that anybody can just buy their way into our group, okay? This is a private security. So it can only be purchased by somebody who's already part of this investment group. Okay, so it has to be bought by somebody else in there for whatever fair market value that you guys agree to. Okay, but and we're kind of, and the sponsors are kind of backstop. Okay, so in an emergency, and you can't find anybody else, we will buy your share. Okay, so that's why my investment philosophy is invest with people who has money. Okay, or somebody in the group has to have the ability, has to already be kind of rich, okay, in order to do this. Okay, because Jack and I, when we buy a property, guess what? We're putting down $400,000 of earnest money to start. Okay, if we don't close the deal, we lose that $400,000. It's non-refundable, right? So we need the capital to do it. We need to also contribute our own money into the deal, right? If we're short, let's say we're raising funds and we're short by like $500,000, guess what? It's our problem. We have to come up with the $500,000 to fill it in, right? So, and then if shit hits a fan for whatever reason, the good sponsors, in order to protect their reputation, will put in their own money to save the project. They're much more likely to care about their reputation and use their own money to save the project. So that's why I usually try to invest with a group that I know has money, or they're partnered with somebody that has the money and care about their reputation. I'm in it for a long haul. Okay, I went through 20 years of tech to build up my powder keg, so I can do this. So so be careful with somebody who's never done it before. It's okay for somebody to not have done it before, but they must be partnered with somebody who's experienced. Yeah. Okay. Moving on. So yeah, so like I said, you have to like paying, right? I'm on the road all the time. I look at numbers all the time. I do models. Traveling to a lot of places. Well, that's not the paying part, but it's the fun part. It's why 2 weeks, as of this month, I resigned from my W-2 job and now I'm full-time doing real estate. Jack is resigned from his, basically sold. He sold all his restaurants, moved to Dallas to focus on this. That tells you about the conviction. Yeah. Okay. So, and what do we do? What do we give our life doing? To deal with units like this. Okay. But this is like basically like a classic unit. It's unrenovated. Okay. And we would take it over and then we would renovate it to something like this. Okay. This is only about $3,000. Okay. Why is it only $3,000? Because I can get a granite for $99. Okay. I can get the whole appliance set, the black appliance set, refrigerator, stove, dishwasher. I can get it for $650 for the whole set. Okay. You guys can probably only buy one. I can buy a whole set. Why? Because when you're buying at apartment scale, I'm buying 200 of these. And then together with my other apartment owners, we are literally buying thousands a month. Okay. And we have special distributors. When you're buying at that scale, they're literally shipping containers of flooring, appliances directly from China to source these materials, selling only to apartment owners. Okay, so when you get to this scale, things become like half or a third of the cost. Okay, this is Vanderbilt. Here's an example, and this is why it works. Okay, so take, for example, 200 units, right? And because we're going with stainless steel, okay, we have going with like new cabinet fronts, it's a little bit more expensive. But this is the kind of value add that we're doing, $5,000 a unit type of value add. Okay. So 200 units, $5,000 a door. Your total capital expenditure is about $1 million. Okay. Now, will you pay $150 extra for this compared to this? You know, so yes, tenants are going to pay $150 extra. Okay. And that's just a low bar, right? Over here, this difference is probably $500. Okay. But if you just look at $150 a unit of rent increase a month, okay? Multiply that by 200 units, multiply that by 12 months, okay? Annually, you're pulling in an extra 360 grand, okay? At this point, you're still thinking residential style. You're thinking that, okay, in 3 years, I'll recover my money, right? But this is apartments. It's different, okay? Because for every dollar that you increase in your income, it's multiplied by 20, okay? It's multiplied by 25, right? It's like think of it like a startup, okay? Startups are valued according to revenue. If you have a quarterly revenue of $10 million, then your company is worth times 30. If your company has 10 million revenue times 30, your company is worth $300 million. If you can increase your revenue to $20 million per quarter, your company is now worth 600 million. Okay, it's based on your performance. It's based on how much income can you generate. So same thing here, okay? The multiplier is 25 for 4 cap, okay? Now, if you're able to increase your income by 360 grand a year, multiply that 25, you have forcibly increased the value of your asset by $9 million. You're not just getting this extra part. This is the difference between residential and commercial. Commercial, because you're now selling a much more profitable business, okay? When somebody takes over, they can immediately get more income. They're buying your income, okay? So with a capital investment of $1 million, you have a one-time capital investment of $1 million, you have forcibly increased the value to $9 million. Yeah.
Like, once if you like graduate all the units and nobody table, you know, like on the table.
Yep.
Well, that exit cap rate be higher.
It will be a little bit worse. Yeah. So it's trick that we do is if we get a property that's mostly unrenovated, we will only renovate to about 50%. And then we would sell it. We will leave it to the next guy. There's a lot of people that actually only renovate to about 60%. Okay. You would have really achieved pretty much your goal by that time. And you leave some meat on the bone for the next guy. Okay. Or what some people do is they will basically upgrade to just black appliances. Okay. And then they'll do flooring, they'll do black appliances. They won't do hard surface. Okay. So the next guy can come in, they can add granite, they can do cabinet fronts. Okay. So they can do stuff like that. Right. So you always want to leave a little bit of meat on the bone for the next guy. Yeah. Very good question. That's why it usually takes about 3 years to get to your projection. Okay, so you can't kick people out. So you only renovate. So you only renovate when the tenant moves out. Okay, so on average, I would say there's a 50% turnover in an apartment. So at any given year, you would expect about 50% of your tenant to move out and new people coming in. So you can turn about 50% a year. So it'll take a little bit, it'll take over 2 years because some residents will renew and not move out. Okay, so roughly 3 years to have finish your renovation plan. Okay. Another thing you can do is, so that's what usually we do. Okay. In the summer, that's what I do. So let's say I charge, let's say the rent right now is $1,000. Okay. And then on new leases, I charge $1,150. Okay. On renewal, I'm going to charge them $11.50 without renovating their unit. Okay, if they pay that, great. I got that market rate without having to renovate. If they move out, I'll renovate and then I'll get that rate.
That's pretty much what we're doing now.
Yeah. So either way, I win, right? So yeah, and then if they move out, then I'll do it. But the thing is, like, you know, you you watch the market very carefully. So right now it's a winter months. So even though our new lease change out, I'm increasing rent by 27%, but on my renewals, I'm only doing 22% increase because I want, during the winter months, there's less people shopping for new apartments. I don't want to lose people. So I want them to stay. And I'm actually very flexible on renewals during winter months because I don't have the traffic to replace it if they move out. So is cash for keys feasible? Well, if you could already charge them market rent without them moving out, you don't really have to pay them cash for keys, right? In terms of eviction, I can tell you that it's much easier to evict somebody in Texas than it is for California. California, San Francisco, you probably have to pay them 20 grand, 30 grand just to get them to move out. In Texas, you don't pay, you don't play. You know, you don't pay, 3 weeks, I can evict you. You're gone. Over here, it could take you half a year to a year, right? That's why you do cash for keys. Over there, they know. So I invest in Republican states, not Democrat states, for that reason. You know, because they hate landlords here. We're the enemy, right? So that's why it's hard for me to, even if it kind of, you know, cash flows. I think the only cases where it makes sense is like if you're like Ian and then you buy multiple units, you start to scale. But single family homes, I find it pretty hard. Yeah.
Talk a little bit more about like say you have a multi-family, just one bedroom, what is the kind of blend that you're looking for?
It's not so much about the OpEx, but your overall goal is to reduce turnovers, okay? Because every time that you turn over a property, a unit, you're spending about $600 in make ready, okay? And plus, it'll probably take you at least 2 weeks to finish the make ready, to look for a new tenant and for that new tenant to move in. So you're looking at maybe about $1,000 every time somebody move out, okay? So, sorry, I forgot your question. Oh, the unit mix. So what I was leading to is you don't want too many 1-bedrooms or studios, okay? So I usually like to see a 50-50 split, okay? Or even higher on the 2 bedrooms, because 2 bedrooms tend to be more families, 1 bedroom tend to be singles. You know, for those of you that are still singles, you guys are gonna buy a home as soon as you get married, okay? And you guys are transient. You guys will move more easier for you guys to move from apartment to apartment chasing the best prices. Whereas a family, less likely to move, they actually maintain the community better because their family is there. They, you know, they actually watch out for the community, talk to each other, they'll whine about somebody throwing something on the trash. So a family community actually does much better. So when I go inspect a property, I walk around, I'm looking at their balconies, I'm looking at like, do I see bicycles? Okay, do I see like inflatable swimming pool stuff? Okay, that tells me that, hey, they have children there. And it's a good thing. Children are a good thing. People with children are much less likely to move every year. Single people are. Okay. But yeah, but that also makes me think of something that's good on multifamily is with multifamily, with something like commercial or triple net lease, you're locked into a certain rent with minimal rent elevator each month, each year, maybe a 2% or 3% increase every year. It's hard for you to react to a large market shift. Okay, so that's why you see a lot of restaurant owners at the end of their lease, they close a restaurant because guess what? The rent is now double. The landlord trying to finally make back all the money that he couldn't raise before, right? Whereas apartments were we can respond so quickly. Every month, we can readjust the price to keep up with the market. So we're capturing all of this as it's going up, as the inflation is going up. Okay. Just real quick. So I'm a very transparent type of person, so people who have invested with me, I mean, Ian is actually invested in Vanderbilt along with York, and they get emails from me. Unlike other syndicators, I don't just do like a short summary of what's going of our performance. I actually write novels with lots of pictures about how the property is doing and this and that, what is everything that's going on. I like to be transparent. It also includes all the financials. If you can't go to sleep, it's usually about like 80 pages, your entire cash balance, your trailing 12 months, what is our, accounts payable, all this kind of stuff. Everything is in there. So very few people actually read them, but for those that do, it's very interesting to them. It's also how I learned, because I learned by passively investing in these deals and watching how the syndicators do it, looking at the financials, because that's the truth, right? And then by looking at that, I learn how they operate and what kind of operators they are. There are operators that basically just check in once a month. At the end of a month, they get this report and they go like, it's a little bit low this year compared to low this month compared to last month. Property management company, what are you doing? And then they yell at them, right? Jack and I, we stare at this data 3 times a day, text them constantly. We have weekly meetings, but even between the weekly meetings, we're constantly emailing and texting them like, let's do this, what about this, and all of that. So I think it's just because of our personality. I'm very hands-on. I want to know every little nitty-gritty thing that goes on. I'm not a backseat guy. So, and I like numbers. Cool. Well, that's all I have. Any questions? I'll bring the whole crew up, and then you guys have any questions, group them.
What drove the sale of that property from a couple years ago? What was the driver for the sale?
It's old property. So when we bought that property, it's a 1969 build. Okay, so we sold it at near pretty good pricing, but we knew that if we kept holding on to it, we had to replace the roof. We have to probably replace 2 very expensive chiller systems. It's like 60 grand, right? Yeah, and I still had about 50% of the units left to renovate that I can leave to the next guy. So we got really good pricing on it. And then I think if we held on to it, we would have had to delay a lot of the cash flow so that we can build up reserve to actually pay for this. Whereas a new group could raise that money, come in, improve the property, and be able to benefit from it. We already spent a lot of our capital already. Yeah. So anything for the team, like how their experiences were? Yeah, go ahead.
Quick question on sourcing. So I know for you guys, like you probably have co-stars or have growth capacity for people who don't have that connection yet. What would you recommend on hunting for these type of multi-family residential?
Do you have co-star? Do you have co-star? Huh? No, the subscription to co-star reports. Okay. So he's asking about co-star reports, which is basically a market analysis report. And I think, fee is kind of expensive, like 20 grand. Okay, so I don't think you want to pay for that. Paul, the lender, would help you run CoStar reports if you ask them to on properties that you want to check out. Any new market that you go to, you should be looking for property management companies because they know the local market really well and they have access to CoStar. They want to be the manager, they want to be the company that runs your property and you can abuse them. Okay, you can ask them all the questions that you want. And then on properties that you're interested in, you can ask them, do underwriting on this for me. What do you think you can achieve? And give me a CoStar report. And they would add, you can ask for a CoStar and a Yardi report and they would run it and give it to you. Yeah. So don't, or sometimes what I've seen people do is they just get it for like a couple months. But you might need more than that. The thing is, it's like if you're buying single family homes, you're going to be running CoStar reports nonstop, and that kind of sucks. But multifamily, we maybe run CoStar reports, only on large properties, or maybe just a few times. I usually get a fire hose of deals, and I narrow down to ones I'm interested in, and then I do some preliminary underwriting, and maybe out of like 100, there will be like 4 that's worth looking at, and then I'll probably ask for CoStar reports on those 4. Yeah.
So how do you anticipate other original SKU?
So generally, I think it's also in one of our things. So I think I'm still confident being able to project. I mean, I don't want to bring a deal out unless it can get about 13 to 15%. Anything lower than that is, to be honest, is also wasting my time, right? I'm gonna run it for 5 years, and also we only get about 10% return, and it's like, doesn't really make sense, right? I'll go drive Uber. Yeah, go ahead.
Yeah, do you have a follow-up structure? Like in terms of the return, would you get after a certain threshold?
Yeah, so I don't have a complicated structure. Mine is really simple, okay? So I get paid nothing until you guys get all your money back. So if you put it 100%, if you guys invest 100K, once we sell the property, all the money goes toward paying everybody back until you guys get all your money back first. If there's anything left over as profit, then we take 18% of that. And the GPs get 82% of the profit. Okay, so this way it incentivizes the sponsors. Because think about it, if I cannot make a profit, I would have worked for you guys 5 years for free. I would have gotten nothing, right? It's really great incentive to make sure that we evaluate the correct deals, that these deals can make a good profit. Otherwise, we don't get paid anything. Yeah.
When you first got started, how did you get a experience with beauty?
It wasn't through beauty. No, but it's more like my experience with the people here. It's like as I meet them in SARE and I chat with them, there's a few certain people is more grounded, and who is willing to, is not super aggressive, and kind of fits your style. And then those are people that you want to work with. So when I was starting out, I was investing in deals, but at the same time, people were also checking me out, right? Because they knew that through my investments, I actually went to some conferences. I knew a lot, more than a typical passive. And then, so that's when they actually started offering me, because, I go to eat dinner with them once a month. I swing by their office, which is called Pete's Coffee, they're there almost like every day. And then, we chat all the time. And then eventually I think we share the same values, and I kind of feel like I share the same values with them, with these people. So you kind of feel like, okay, these people I think I can work with, because deals are easy, getting money is easy, finding good partners is hard. Okay, that's a really hardest part. So I was really lucky that I found Jack. You know, we work really well together. And then I think the next generation of sponsors, you know, these people I have absolute confidence in. So yeah, I mean, I think, you know, it's really because they are eager to learn, but they're not aggressive and like, I'll partner with anybody, or I will go and find any deal that to invest in. No, they're not like that. Right. So, but yet they're all very, they're in a huge learning mode, and they are exposing themselves, right? They go to conferences and they actively go and talk to people, you know? So I think all of them are like pretty well known in the SARE circles, right? Because they get themselves out there, right? So yeah, get good exposure and then let people get to know you, and then people will want to work with you. Yeah. But you'll find people on the same wavelength as you.
So what are you thinking about your next deal?
My best deal?
Next deal, next deal.
Oh. We're not selling anything in this thing, but please join, you know, please talk to any of the people here. They will know when the deal is available, and then you can work with them, or, you know, but we're always looking at deals. Like I said, I'm lowballing so many people. Damn it, what happens if one of them actually gets it, right? So I don't know when to tell you when the next deal is coming, because we're submitting offers like every week. Okay, and I don't expect them to be accepted because I'm not offering high, but I'm relying on my relationship with the brokers and with people like Paul, who's gonna be able to put in a good word for me to let people know that I have guarantee of close, right? And one of these sellers will be desperate enough to accept my offer. So by that time, so keep your powder dry, because, you know, when the deal comes, it comes. You know, and I don't have time to warn you guys ahead of time. So get on all these emailing lists, get to know these people, find a ways to contact them, you know, and or, you know, you can message me over Meetup or whatever, right? But I really prefer you guys to start talking with the Linfinity squad here. You know, they will be able to ask you, because they will be able to support you. You know, the young people are hungry. The people who are in the business are hungry. They will, a lot of times I think the young people will do a better job than a syndicator who has done 10, 20 deals. They kind of get complacent. They kind of get comfortable, right? Where the young people want to do it. Yeah.
Sounds like your deals, you're going after markets that are more rent control friendly, maybe not so much in this area. But if you're a limited partner interested in investing in this area, would you start to change your mind if it's more of a buyer's market in the Bay Area, or would you still stay publicly based?
There needs to be a compelling case for me. You know, I need to see a way to profitability, you know, and not just because I would characterize California as an appreciation market. You know, so where people are willing to take some losses because they know, rightly so, in the long term, it's probably going to appreciate, right? But in my experience, by investing out of state, I can appreciate, do forced appreciation. I can probably make the people more money investing outside. So yeah, I really don't want to have to be a landlord here.
So feel like actually we kind of 8%. So essentially you need like, let's say $250,000 or $500,000 to just deal going for attorney fees and all this stuff. So where do you keep your cash in the meantime? Where do you keep your cash?
each other kind of like.
It sucks. I'm doing exactly what Patrick said not to do. I'm keeping it as cash. Because as a syndicator, I need to keep liquidity, right? But other than that, I do have a home equity line of credit, that I don't have to draw on until I need to. Right, so that's a nice thing about home equity line of credit. So I would, because we have different assets at different classes, right? And if I find a deal, guess what? In 1 week later, I'm putting down like a $400,000 earnest money deposit, right? Well, the home equity line of credit allows me to get that fund immediately while I work on my other investments to clear that out. So to release those funds so I can clear out my home equity line of credit for future uses.
So normally 100% GP will be 100% for the whole.
I would say usually 8 to 10% of the deal, of the raise. Yeah, typically it's about 8%. Yeah, but it's different for every deal. It's really like, I can tell you that we had to decrease our GP share by 100 grand on Vanderbilt because we were raising 9, and then we got 14 million of interest. And then to fit people in, we had to try to go talk to people to reduce their shares. And then to actually fit in last 2 people, Jack and I, we had to reduce it, but we didn't want to reduce it by that much. So we in total had about 700 grand into the deal. We moved it to 600 grand so we could fit another investor. Yeah. Okay, cool. Thank you guys.